All right, so the G20, the big focus, of course, on currencies, on China and the U.S. and currency tensions. Art Hogan, Chief Market Strategist at Jefferies, joins us now to talk about what it means for the markets. Art, let's start with that. I mean, what do you think in the aftermath of the G20 it means for the market? We were expecting this talk, but what does the market do in reaction?
Well, it's interesting. We come out of the G20 in a different place than when we went in. Obviously, we weren't very popular during the meetings. A lot of rancor about our aggressive monetary policy. And interestingly enough, the week up till the G20 meeting, the dollar actually firmed because there were so many concerns about the European sovereign debt on the periphery. So you sort of come and go. G20 comes and goes. Everybody wants to talk about a sort of unified currency or what the alternatives are, but nothing's going to happen. It doesn't seem like anything of substance has come out of this.
When it comes to commodities, of course, we've seen almost daily a record close for gold futures. Obviously, people fleeing to that as they're seeing a weakening dollar. Your take on that in the long run? Is this a long-term bet?
Well, it's a very difficult long-term bet. Now, I will tell you this. In the near term, I think there's a certain amount of volatility and danger at the current price of gold. I think in the longer term, it's going to be that haven for safety as all currencies debase a bit. Where everybody's having a race to the bottom in their currencies right now. Monetary policies can continue to be aggressive globally. So I think gold will be that harbor of safety until it's not. So our near-term target is 1425, which is we're on the door of that every single day, and our longer-term target, gets you to 1,600. We're certainly not of the school that this is a $2,000 or a $5,000 an ounce commodity, and we certainly don't think we're going back to a gold standard. But I think in the long run, a percentage of your portfolio should have some protection with gold or other commodities, and I think that's going to be the case for the next 10 years. Treasury
Secretary Geithner this week really lashing back at those that have said that the U.S. by the Fed pumping in $600 billion, that they're trying to weaken the U.S. dollar so that our exports increase to stabilize our economy. Geithner saying that's not the case whatsoever. But in terms of the market, whether or not that was the intention, we have a weaker dollar that's making our goods cheaper. What does that mean for U.S. companies right now and for major exporters?
Yeah, that's exactly correct. We're more aggressive with monetary policy than anyone else on the planet right now. So the end result's going to be a weaker dollar for a period of time, and that's a benefit to our multinationals and our exporters. You saw that reflected in the trade gap numbers that came out last week. Our exports are going up. It's starting to work. So we're going to be more competitive in a global economy for a period of time. That the dollar continues to weaken. That's probably going to be the trend for at least 6 months. So when you think about exposure to this market, you want to have exposure to companies that are doing more than 50% of their top line revenue outside of the United States, whether it's into Europe or into emerging markets.
And given the surprise announcement that we heard this week, the heads of President Obama's Deficit Commission coming out with a plan to reduce our debt by $4 trillion by 2020, does this indicate to those outside the U.S. that this country is getting serious about tackling our debt issues?
Yeah, it couldn't come at a better time because we're talking about austerity plans, across all of Europe. And when you look at a debt to GDP ratio, the United States is just as bad as a lot of the sovereign debtors in the Eurozone. So I certainly think that talking about reducing our deficit, talking about reducing the size of the government is going to be on the front burner for the next 3 months in the lame duck Congress, and we're actually going to see things happen in the first sort of quarter of next year. So it's going to be interesting. I think the marketplace is going to, the global marketplace is going to reward that for a time being, but it's also going to try to make bets on that. So you're going to see things like aerospace and defense probably get hit even more than we saw coming into last week.
And also heading into next week, anything that's not getting a lot of focus right now, obviously the focus is on the G20 and on the Deficit Commission, that you think needs to be paid attention to next week?
Well, the three things you want to focus on next week, I think, in no particular order. Economic data is going to continue to be extremely active next week. We got to look at the industrial production and capacity utilization numbers. That's one of my favorites, so keep a close eye on that. We'll also get a peek at the CPI and the PPI. We want to see a modicum of inflation. I think that's important, so keep a very close eye on that. Then we get housing starts and building permits. Obviously, that's important to us. Away from the economic data, we're going to hear an ongoing conversation about extensions of tax cuts for everybody. That's going to be the front and center conversation next week. The more we hear about that, the more likely it is that it's going to happen. So over the next couple of weeks, look for that to be happening. The third thing is keep a very close eye on commodities. There is a tipping point at which energy prices get too high and it pulls back on the consumer, especially during this very important holiday season. So we want to make sure oil stays under $90. That's going to be that's kind of the new line in the sand that we don't want to cross, and we want the holiday shoppers out there and confident, not having to pay too much at the pump.
Sure, and amid all the news that's going on, no one's really looking or talking about oil. An important thing to keep your eye on heading into next week. Art, thanks so much.
All right, take care.